This is Sharon Garvin of Wayne State College, and this is my screencast for cost of quality topics inside the Accounting 2 online course. There really isn't a standard definition of what quality is, other than what we have up here, in that quality is perceived as being how well a product or service meets the particular customer's needs. What that means is everyone's definition of quality is a little bit different depending on the item. So if you and I were going to shop for cars or vehicles, chances are we would be looking for different things. You might have a different size of car that you're looking for compared to me. Or maybe you want two-door and I want four-door. Or maybe a big engine is important to you. Or maybe good gas mileage is important to you. Or maybe color is important to you. Maybe safety is important to you. Maybe durability is important. So it's basically defined by a particular consumer. We can, though, generalize and say most people would say that quality product is something that performs the way it was advertised to perform. It does what it's supposed to do. If there are optional features, a person would define quality as having those particular features that they want. Or in some cases, when some of our products get overly complicated, some people might choose a simpler product without a lot of extra options on it. We want the product not only to be useful the first time we turn it on, but every time thereafter for a significant period of time. If we accidentally drop it, we want it to be durable, not easily damaged. If something does happen to the product and we have to bring it in for warranty service, we expect that service to be done quickly and by competent people so we don't have to bring it in for the same problem. And then the bells and whistles down here that generally people are looking for things above and beyond. Does the product do what it's supposed to? Does it look nice? Does it feel nice? Does it have a new car smell? Does it have a superior audio system or stereo system? You know, if it's food, does it taste good? These extra things are people willing to pay more for because they have what we call the bells and whistles in business. Alternatively, if your product is of poor quality, that means it comes off the assembly line, it's probably defective, and someone's going to have to remake it. That will probably require additional materials because the first one that came off the the assembly line being defective, will have to have part of that, if not all of that product replaced as far as materials go. And then the rework done by people is going to cost us more in labor hours. There might be additional overhead costs that are incurred because we have to rework products. So all of these things make the operating costs of the production facility go up. This means we have less productivity, and productivity is kind of the number of items we can crunch off an assembly line each day. So if every fifth item is a defective item, at the end of the day when we see how productive we were, how many items we make, it's a very low number. And because we have a low number of items we actually made, we can't sell a lot of items because we don't have many items. So that could possibly cut into our revenue. When your revenue is down and your costs are up, that means together that your profits are going to be extremely lower than they would if you had a quality product. Because you're not making as many good items in a day, you might have to call up the customer and say, I'm sorry, we're not going to be able to meet the shipping deadline that we agreed upon. You might have people that have low morale. Nobody really wants to work for a company that manufactures junk. You might get paranoid about the problems in your products, and you might inspect it 4 or 5 times instead of inspecting it once at the end of the period, so your inspection costs might go up. And again, if it doesn't work, the customers are going to have low satisfaction. Eventually, they're going to get tired from the products not working the way they're supposed to, and they will take their business elsewhere. So you'll have less of a share of the market, and this trend could continue until the manufacturing organization actually goes out of business. So here's an example of a cost of quality report that I show in my classes on campus. And it's divided into the 4 categories of prevention, appraisal, internal failure, and if we scroll down here a little ways, external failure. And so the accountant supports the total quality movement by keeping track of the dollar amounts spent on the items under these 4 categories. We keep track of not only dollar amounts, but sometimes we use percentages. These are dollar amounts so we can compare to sales to see how much we're spending in each particular area relative to the sales or size of our organization. We can also take these dollar amounts and divide by the company sales to see what percent of sales the company is investing in each of these particular categories. So for example, for this company, they are spending $1 million on prevention here in year 2 compared to only $650,000 in prevention in year 1. The sales for the company for both years were the same. Generally, that's not the case. So we can just look at the dollar figure since sales are the same. Generally, a company would calculate each of the dollar costs as a percentage of sales. And notice we went from spending 1.3% of sales in year 1 to 2% of sales in year 2. So prevention costs are one of those things that managers actually can control. They can make a deliberate decision that they're going to spend more in the prevention area. And we've talked about the phrase, an ounce of prevention is worth a pound of cure. Investing more in the prevention cost area should save you more money down the line if you spend your money wisely. So this is a good strategy for managers generally to increase their spending on prevention, either in terms of dollar amounts or in terms of percentage of sales. The second category would be your appraisal costs. Those are testing costs. We're either testing raw materials, we're testing work in process, we're testing finished goods. And so again, we noticed that this company spent $1.2 million in year 1, $1.5 million in year 2. This is an area again that management can control. This company's management made a deliberate decision to invest more in the area of appraisal and test more. Instead of spending 2.4% of their sales on appraisal activities, they're now spending 3% of sales. Again, the theory is if you spend more on testing in the appraisal area or inspections in the appraisal areas, you will have less defective units going out the door, which would result in external failure costs, which are the most expensive type of quality costs we can have. So management making a deliberate decision to spend more on appraisal is generally a very, very good strategy as long as they spend the money wisely. Failure costs can be divided into two categories. There's the internal failure costs and there's the external failure costs. As indicated in the other materials for this part of the course, internal failure is for anything that goes wrong while the product is still at the factory. So if we have defective units, or we have scrap, or we have to redo the product because it was defective, or because we had to shut down an assembly line because one of our machines was manufacturing defective products, or we have to dispose of defective products. Those are things that go wrong, but they go wrong while the product is at the factory. And as bad as those are, they're really not as bad as down here, the external failure costs, which are things that go wrong after the customer has purchased the product. So when the customer gets a product and it doesn't work, we have to repair it, or we have to replace it, or we have to give them some of their money back, or we have to send somebody out to their business site to replace the item or fix the item. So external failure costs have the potential to be the highest or most expensive because they involve recalls and lawsuits and things that are very, very expensive. Anything you can do to reduce that dollar amount is a good business strategy. Notice that because the company took a proactive effort up here and deliberately decided to spend more on prevention and more on appraisal, then when you get down here to the failure costs, even though the internal failure costs were up, because it's going to take a while for the increases in preventions and appraisals to result in cost savings in the later categories, we noticed that the external failure costs went down significantly from over $5 million spent to only $2 million spent. That's going from about 10% of sales for external failure costs down to only 4% of sales. Was that a good strategy that business management deliberately spent more on prevention and appraisal so they could save more on the failure costs? We'd look down here at the dollar totals and say, yeah, that was good for the company. Instead of spending $9 million, they only spent $7.5 million. Instead of spending 18% of their sales in quality categories, they only spent 15%. So it's gone down. So we're concerned about the dollar amounts going down. We're concerned about percentage of sales going down if the company had significantly different amounts of sales in the 2 years. Realize that the internal and external failure costs generally cannot be controlled. If something goes wrong at the factory, I guess we can decide whether to rework it or not. But the mistake or the problem or the thing that's going to cost the company money has already happened. External failure costs, again, management really can't do a whole lot about that. If people are using a product, it breaks. That's going to cost the company money. Even if the customer doesn't bring the product back, they're going to be dissatisfied and, again, in the future, take their business elsewhere. So we have lost sales and we have lost market share to think about as well. Prevention and appraisal management can do something about things that go wrong either while the product's at the factory or things that go wrong after the customer buys it are much less likely to be controlled by a manager. So you as a manager need to think about how you can wisely invest money in the top two categories, the prevention and appraisal, to hopefully reduce the cost of the internal-external failure such that the total cost of the company is minimized, or the total percentage of sales spent on all the four cost of quality categories is minimized. This ends my screencast for Total Quality Management, part of the Accounting 2 online course.